Mahesh Patil joins us. Mahesh, good morning. Thank you for joining us. Mahesh, let's demystify this entire narrative which everybody is talking about. Markets will go down because bond yields have gone higher. What is the correlation? And can we ignore it? Or this is something which will have long-term serious implications?
Yeah, so I think, there is some correlation between bond yields and the market, but that is over a longer term, I would say. Initially what happens is that when you come from a downturn, and that's what we've seen, when the growth starts to pick up, there is bound to be a rise in the bond yields because bond markets will believe that inflation will catch up over a period of time. The central banks would raise policy rates, and that would start impacting the valuations of the companies because we've seen that in a period where bond yields were at very low levels, almost zero levels, the P multiples tend to be on the higher side because your discounting rate is lower. But I think what happens is that one should not understand that as growth picks up, earnings growth also starts to pick up, and that we've seen the earnings growth across the board surprising in the last quarter. And growth actually predominates in the initial part of the recovery than the increase in bond yields, which could have an impact on the valuations. But I think after a sharp rally, what we have seen in the market, I think some of the near-term concerns like the increase in the bond yields, I think is a reason for the markets to take some correction. Also, some amount of money which had moved into the market, right, on the basis of low interest rates, I think that could get pulled back a bit. But this is I think, short-term impact in the market. I think overall, I think from a medium to long-term perspective, if the growth recovery is strong, I think that will continue to drive the market higher. After a kind of a brief adjustment, the market does to the current bond yields.
Okay. Mahesh, some would argue that in the near term, markets are pricing in a lot of good news. The fact that economy is on a mend is a fact which everybody is acknowledging and admitting. The fact that Q4 earnings will be decent, it is of public knowledge. The fact that managements are starting a capex is also something which markets have acknowledged. The fact that PSU stocks or PSU disinvestment drive will pick up, the government has really shared their plans on a larger forum. So my question, Mahesh, is that while what is happening both in terms of incremental and transformational changes in the economy is good, it's great, but are markets pricing that in? And for markets to go higher now, what is next?
Yeah, so you're right to some extent that the reflation in the market because of the easy financial conditions and the liquidity has slightly gone ahead and tried to factor in some of these factors. But I think, again, after the initial rise, I think market is bound to take some pause. There's bound to be some correction based on some of the negative news coming in terms of increasing the total COVID cases, what we've seen escalating. But I think that's the part of the market rally, right? I think we think that the growth improvement, what we are seeing is going to sustain. And if it's going to indeed sustain beyond the next 1 year, which is just coming from a lower base, then the growth trajectory, for corporate earnings over the next, say, 3 to 5 years can be much higher. And I think that is what the market is still not discounting. Market is probably discounting what the growth will be over the next, say, 1 or 1.5 or 2 years at best. And I think as that unfolds, market will continue to scale higher. Even in the best of the bull markets, we have seen the markets tend to correct by around anywhere between 15 to 20%. And I think market is probably taking some pause and reacting to some of these news globally. And we are in a correction phase. But I think it's going to be purely earnings from here, I would say. I think the more and more sectors, as they come out of the impact of the pandemic, you would see these sectors recovering. And for the first time, we're seeing it's across sectors, right? It's not only the so-called defensives, IT, pharma, consumer, but even some of these domestic cyclical sectors. Capital goods sector also is showing some promise, okay, with investments likely to pick up on the back of the government initiative taken on the PLI schemes. So it will take some time. But when you have more drivers and more sectors participating, I think the recovery in the earnings growth and the sustainability of that becomes much more stronger. And that is what is going to take the market higher in the medium and the long term.
How exactly do you see the redemption picture moving for domestic investors, Mahesh? Because it's been for 6 months now.
So I think the good news is that we have seen the redemptions pressure, which was there in the last 4 or 5 months, that's easing off a bit. We saw that in the month of February. Even in the month of March also, we've seen that the redemption pressure is easing off. So I think clearly, I think initial reaction of the investors to take out money as the market rose, I think that is now kind of slowing down. And investors would hopefully take a slightly longer term view on the market. And my belief is that if you see some correction in the market, okay, what we are witnessing right now, I think that will, nudge investors to put in money and buy into that correction. So I think next year, the next fiscal year, I think the whole redemption pressure, I think, should ease up, and I think we could possibly see some net inflows coming into the mutual fund industry. I'm pretty hopeful of that.
Okay. Commodities, Mahesh, I wanted to get your take, given the current global environment and what we have already seen. You have been fairly bullish or active on some of those steel majors as a fund house. What's your outlook on that front going forward, and what gives you the confidence that we'll see this trend sustain?
The commodity trade is driven by two factors. One is obviously the demand and supply side equation, which is currently favoring because supply is not being able to catch up with the sharp increase in demand, what we have seen, especially the recovery in the China, where the economic growth has now come back to the earlier levels. And demand side issues is still supply is still trying to catch up with that. Also, a lot of capacity in China has been shut down because of environmental issues, and that's not going to come back to the market. Third factor is that even from a medium-term perspective, we've not seen any large investments in the commodity sector, especially metal sector, in the last 4 or 5 years. And that will keep the pressure on the supply side. And second factor is the dollar. Okay, so the dollar weakening is also something which was driving the commodity prices higher. And there is some amount of speculative interest also, which is coming into play with low interest rates. Some of the money moves into the commodity markets and tries to play over there. So all these factors, I think, still continue to hold on. And given that scenario, I would say commodities, at least the outlook over the next 6 to 9 months, looks fairly strong over here. And while the stocks have rallied, they are still at, if you look at the price to book value, they're not that expensive. And there is also a deleveraging story which is playing out because this year the cash flows for a lot of the commodities will be very strong, and that will be used to really pay down the debt, and that would also benefit the overall balance sheet for some of these commodity companies.
Okay, so that presents a strong case there. Back home and on the infra story, given that we've seen such a substantial push on it, and expectations are that with the cyclical uptrend, we will begin to see a much more resounding growth story on that front. Would some of that rationale also flow in and apply to some of those infrastructure, capital goods names, materials, or would you still be a little cautious on that front?
Yes, so infrastructure sector, clearly there is, after the budget, we have seen a major push over there, especially the road sector, which has kind of slowed down in terms of ordering over the last couple of years. I think we are seeing a renewed interest in terms of new ordering coming over there. The challenge for the government has been in terms of the funding, right? Where do you get those funds? So I think the new infrastructure development fund, which has been formed, if they're able to really ramp it up and get funds over there, I think that should provide some of the needed capital for the government. And also, the government is looking at various other options of like the InvITs, okay, to monetize some of the assets and plow back that into new projects. So if that takes traction, I think you could see more money coming in towards the infrastructure sector, and some of the companies, especially in the road, urban infrastructure, should see decent growth in terms of their order book. The capital goods sector is also looking at still early days, but I think the government push on Make in India, the PLI scheme, which is now being rolled out across sectors and is covering more number of sectors, I think that should drive some investment in the private sector. But large investments, I think, which is there in the power sector, for example, or in the metals and mining, I think that will take some time. So I think selectively in the capital goods sector, I'm just saying you should see improvement, but very big ticket private sector capex, I think, is still some time away.
So given, Mahesh, that it's not going to be a linear move in the markets, as was the case last year, barring a few aberrations here and there, and that it is going to be a volatile ride for the market, as it already has been since the start of the month, would you say one is safer having a larger exposure to large cap? And even for mutual fund investors, are they safer right now in large cap funds, or would you say it has to be a mix of both? That's mid caps as well as large caps.
So I think it has to be more balanced approach. I think large caps definitely provide more stability, and in this kind of an environment, it offers much better downside protection, relatively, I would say. But I think one has to take a slightly medium-term view, and with the outlook on the overall growth, I think, as we have mentioned earlier, we're looking at a new economic cycle playing through. So in that environment, even the mid-caps and small-cap companies, which are more dependent on the domestic growth, will also do well. And one would also want to really participate in that. Agreed, in the near term, there could be some volatility over there, but that would be an opportunity. So given that outlook, I would say a balanced approach with some large caps or probably a multi-cap fund would be a better option, okay, to really look at. I think that would do well for investors to look at it. And even some allocation to mid and small cap within one's risk appetite, I think should also be looked at, because I think over a 3-year period, 3 to 5 year period, I think the mid and small cap should also deliver good returns, is what our view is.
So Mahesh, if an investor were to come to you right now and say that I'm not looking at the next 3 years, but in the next 1 year, how do I get rich? What would you advise him?
So I think you can't get rich in 1 year. You have to be patient for that. So, but I would say that somebody looking to invest even from here at the market levels, I think the long-term risk reward is still favorable towards equities. I think equities will still give you returns which are higher than the risk premium, okay, what equities have historically demanded. We think the returns could still be around 10 to 12% in that range, which is not bad considering the fact that inflation would be around, say, 5% or so. So one would, with that kind of a view, one would recommend that the allocation towards equity can still be slightly higher than what your long-term target allocation should be. Obviously, considering the near-term volatility and the risk, I think it would be better to really spread it out and not really put that at one go. Market will give you opportunities, and one should take their opportunities to really increase the allocation if somebody is underweight over there. So I would say a slight higher tilt towards equity from a longer-term perspective would do well. From a 1 year perspective, I think I would say that it's better to look at some of the more less risky options on the equity side, be it the asset allocation fund or the balanced advantage fund. I think that would do well for investors if they have a shorter term horizon.
Just one of those days where nothing is going up in a very significant manner. The entire F&O space, which is what I'm looking at the screen, there are only 2 stocks which are trading with a positive bias, and that too hardly. In percentage terms, it's 0.2% for ICICI Pru and about 1%, not even 1%, like 0.2% for Bharti Airtel. That's the way how things are really in terms of the selling. And it's not that we've got very large amount of selling. Today, the HNI stocks are just getting smoked, whether it's Tata Motors or what is happening in SAIL. The way some of the HNI stocks are getting smoked, it just tells you that there seems to be a general risk aversion which has kicked in. Variety of factors could be at play, lack of triggers, momentum broken down, US bond yields, nothing in the short term which will generate upside momentum. So we are going through a patch of the market where if you try and time the market, if you're a trader, trust me, I'm speaking this based on experience, it may not be a very fertile hunting ground because there is no trend. Today, we've gone down. Yesterday, markets were choppy. Monday, global markets come back. You may be seeing some degree of appreciation. But I want to go back to that point once again that if you look at Indian markets in totality and compare that with what other markets have done this year, we are still in the green. We are still above the budget days low. Stocks which are trading significantly above the budget day lows, that include banks, a lot of PSU names and a lot of cyclicals. Mahesh, how are you approaching PSUs? Because there are some PSUs where strategic sale will happen. There are some PSUs which are on the brink of increasing their dividend yield. There are some PSUs which have become strategically important like a BL or BML.
Yes, the PSU space still offers a reasonable amount of value if you compare it to the broader market. But again, in the PSU space, it can be a bit tricky. So you have to not get into the value trap over there. So I think one obviously is where companies where you see some value unlocking because of strategic sale. I think that is clearly one place, okay, where one can look at it. And normally what happens is when a private buyer comes in, okay, there is some amount of cost efficiencies and the same which comes in. So there is always an upgrade to the normal earnings potential, okay, what one would see. And there is a chance of a P re-rating over there. And a lot of the PSUs are pretty strong, dominant. They have got a dominant market share in the sectors where they are. So that would do well for these companies, okay, in any kind of a private suitor. Apart from that, I think the other PSUs, I think one has to see in terms of what is their, while the companies will grow, but what they're doing with that cash. Because the PSUs in the past have not done the right capital allocation decisions. And that's where the cash flows have been there, but they have not really rewarded the shareholders. So I think one has to really clearly see individual companies, what is their capital allocation plan and how they are deploying that capital, how much they are returning back to the shareholders if they don't have any use of that. So I think companies which have not clear policy in place, I think there is still enough value. And as rightly mentioned, the dividend yield in some of these companies is still fairly good, okay, for somebody for a value investors to really look at these names. So I think a combination of all these factors, that some amount of value unlocking, some amount of asset sales the government is talking about, which is there in some of the PSUs, though it's a pipe dream, but I think if that materializes, I think that could also unlock value. And I see finally one has to be fundamentally positive on the business, right? If the underlying business is not doing great, I think then there is no real money to be made in the PSUs. It could just be a short-term trade. So by and large, I would say it still looks promising from where the valuations are. And I think if one is looking at not a high growth stock, but more of a kind of a value stock and with reasonable returns with good margin of safety, I think some of the PSUs still offer that opportunity.
Mahesh, I have a simple question. US economy is likely to do better. If US economy will do better and if there is fear of inflation growth coming back, isn't that a natural tailwind for IT and pharma? But in this fall, IT and pharma have fallen. In fact, pharma has fallen much more than IT also.
So I think see, pharma in a sense is not so much linked to US GDP growth. I think IT definitely has a correlation over there. So I think in the pharma sector, I think it's more of pharma rallied much earlier. It did very well in the last calendar year, and probably it is taking up a pause. And we're seeing a sector rotation, okay, which is moving into cyclicals. Is the reason why the pharma sector hasn't done as well in the last 3 months. But otherwise, I think the pharma sector, I think there's not much change in terms of the earnings growth, earnings trajectory is what one was looking at. There was some tailwind in the pharma sector because of the COVID, right? In some of the drugs, we saw a sharp increase over there in the offtake, which might not be there because now as vaccine plays out, has been mostly you might see the COVID-related uptick will slow down. But I think the sector looks now, I think, fairly good. The pharma sector, I think, looks more reasonably priced now. And I think should do well, I think, in the market correction is what one would presume. The IT sector clearly is in a slightly better trajectory, and with, as rightly said, with US growth coming in, we've seen the spend in IT is increasing. Also because of drive toward digitization, I think there is higher spend. And I think there the revenue growth, even yesterday, the Accenture numbers which came in also showed increase in terms of their outlook. So I think that sector, I think, should continue to have a tailwind in terms of revenue growth. Obviously, the margin improvement, what we saw in the last 2 quarters, I think that would probably take some backseat. So on balance, I would say, I mean, besides, I mean, the sharp rally, what we see in the IT sector in the recent past could be a reason for a mild correction. But I think there, the outlook still remains fairly strong. And with US economy doing well, I think the revenue growth for the IT companies, the order inflow should remain fairly robust.
Good chatting with you, Mahesh, and getting all those insights from you. Thanks as always for stopping by.